Hi all, I am Sham. I have Kishan with me.
Hi everyone.
Welcome to Free Float. Today's topic is low volatility, that is, stocks that don't move. But before we get into that, let's recap. Why stocks that don't move is attractive. Compared to momentum stocks, which is stocks that move everywhere. So, Kishan, do you want to recap what we discussed last week?
Yeah, so momentum is like one of those factors that, or not in factors. I think people have not heard of factors strategies. Have heard of momentum. And it's I think it's the most popular thing in India. Everyone does some kind of momentum, and uh, and because it is exciting, most people want to when they invest in the market. Even professionals want to have fun. No one wants to do something that is unexciting, where stocks will move. Even the clients want their portfolio to jump up. I in fact had a conversation with someone today, um, and we were just talking about market and stuff, and I told him we were talking about how we are doing and what the market is. And I told him, if you go back 2 years ago, Nifty was at 11,400. Today it's 11,400. So even if you got some 5%, 6% annualized gain from your portfolio manager, it's actually a good return. But he's like, no, stocks have gone up. In the last 6, 7 months, they've gone up 35%. All that. Yeah, I said, somebody might have got the timing right, but most investors when they uh, invest in the market, they're doing it not only because they want to earn a return, but they also want to. It's something that excites most people. So
Right.
momentum satisfies that goal. Low volatility is the complete opposite of that. I mean, you have to be extremely
So
patient.
before we jump into low wall, right? So I'd like to plug our all-star portfolio. So basically one of the different ways in which you can access momentum is just buying stocks that have hit their all-time highs, right? So we even posted a back test for people who are interested in looking at historical performance. And while we consider 25 stocks for the portfolio, the nature of the beast is that most of the time there aren't 25 stocks in the large cap universe that have hit their all-time highs. So most of the time, you're looking at considerably less than 25 stocks, but so the slots that are free, right? You can buy a bond fund or something that sort as a placeholder and earn a return on that cash part as well. So that's why we kind of kept it open ended in the sense it is not a managed portfolio of any sort, either on StockWiz or on small case. We are sending out these trades as emails so that subscribers can figure out what they want to do with it and manage their own cash in a way that suits them best. So if you haven't checked it out, please check out the backtest and subscribe. The details are in the backtest Substack newsletter. And that's the end of the plug, I promise. So let's look at low volatility, right? Stocks that don't move. So what exactly? I mean, if a stock doesn't move, why should anybody invest in this?
So Sham, I want to know from you. Do you I mean, are you the kind of investor who likes low volatility as a strategy?
I have a nuanced opinion on it. I don't like a portfolio of low volatility stocks. I feel that to give you some historical context, my first impression was that of British Petroleum, right? I don't think. I mean, do you remember the deep water spill?
Yeah, Yeah.
right? So that was a disaster for British Petroleum and a bigger disaster for the Scottish Widow Fund, right?
Yeah.
So they were a big investor of British Petroleum, primarily because of low volatility
Yeah.
and the fact that they were giving a big fat dividend, both of which went out of the window. So when they wanted to sell it, the price has tanked because of the spill, and BP subsequently had to cancel the dividend because there was no money coming in.
Yeah.
So my impression of this portfolio of low volatility stocks is that you are taking this cliff risk,
Yeah.
this fat tail, so to speak. So you're sitting there like a dodo with a stock that doesn't move and thinking that you made a very smart choice, looking at other buffoons who are chasing after momentum and or just index
Yeah.
investing and say, hey, you know what, I'm low vol, I'm happy. So then some event like this happens and your low vol goes for a toss. So I'm not a big fan of a portfolio of low volatility stocks. No.
Okay. So for me, so I'm actually a big fan of low volatility stocks, and the reasons I think I like low volatility is because I don't like surprises. I think growth investing. When you're investing in a very very high growth sector where there's a lot of interest by all participants, retail or like institutional, a miss can have disastrous consequences. Like a company misses its earnings or misses its expectations, or some pipeline of launches is delayed. The stock comes crashing down. And it's virtually something that you cannot. I mean, Uh, it's like the party thing where you have to sit down at you have to make sure that you're dancing till 12, but there's no clock. So you have to, as long as the music playing, you have to stand up and dance. But as soon as the music starts, everyone is out of the door, and so that is always a very hard thing to do, I think.
Yeah,
And
I mean, I agree to some extent. Like, both growth and low vol has its different risk profiles. But the thing is, it is something like this, right? Say, this will appeal to software guys especially. So, say you set up a job, right, that sends out an email every night after it finishes, right? That is an idiotic way to set it up. You wanted to send an email when the job fails,
yeah,
right? So what happens is, if it is just giving you success, it is very easy to miss.
yes,
So, but if you get an email only when an event occurs, then you go out and investigate it. I feel that is a big difference between growth investors and and low vol guys. So growth investors are always on the lookout, so they're always alert, right?
yeah,
And they have their guns locked and loaded, and their trigger finger and their fingers are on the trigger, so they can pull it if something happens. But low vol guys, the news kind of comes out of nowhere, and they're ill prepared to figure out what to do.
yeah,
When that hits them. And in this deep water spill is one such example, because it's not like the news comes at you in a well packaged, everything tied up in a nice little bow in one
yeah.
shot,
Yeah, I
right?
think I think the part that I like about low volatility, the kind of companies they tend to be also. So these are companies that have probably endured for hundreds of years. Maybe some of them. It's a product that Uh, I mean, it's got a good demand for its products. You can see visibility for it. It's mostly run by by management of companies who are probably smart individuals, but not very ambitious. I mean, in the sense that they're not trying to become the next they're not going acquiring bigger companies than them, or they're I mean the company is growing or not growing, it's going probably 1 to 5%, very in low single digits. And they have normally these companies have low debt or no debt, you know and because the rest of the market ignores them. I think most market participants might not even know that these stocks are listed, or or they may not realize that what's happening in these stocks, because no one talks about it. Like you sit on CNBC, you might not see the stock mentioned for many years,
Right.
And it's all the ignorance of the market and stuff. I think that creates this uh, this market anomaly, you know. So where the earnings and stuff are growing, but the companies tend to be undervalued, or they produce, I mean, like positive returns from a stock perspective year after year, but it gets ignored because it's not growing at say 20% per annum, for instance, but it's going probably it's 10, 7, 8% consistently, So I think that those things get missed by the market, like like quite a bit, and that creates a market anomaly. Like you can only the market behaves inefficiently only because of certain quirks, like
Right.
a certain like idiosyncrasies, and I think that's what captures that anomaly.
Right. So these are basically stocks that are bond-like, right? So we see that term thrown around a lot. So stocks that give out big fat dividends and basically no surprises. So I think we discussed ITC last week or something, and that has a 5% yield. That is one of the lower wall stocks. I think today we looked at which one was that? Gillette.
Yeah, Gillette. So Gillette,
Yeah.
Gillette has a like ROE of 27%. Growing at a growing. I mean, not growing much. I think it's. The growth is negative the last 3 or 4 years, but it's good. But it's like in -1, -2%. Like per annum, and then no debt, and the company has a beta of 0.27. I mean, if you're looking at a hedge, from the market, from like a safe haven from the market or from growth stocks, it's a good place to be in, because the market share, I mean the company's position and stuff is pretty strong. So and it's endured for a long period of time, and it will endure for much longer. So um,
Well,
like I mean but
that's kind of what is embedded in the price, right? That they will endure. But you see at some of the, I mean, if you go to like DMart or one of those stores, you will get a wide variety of options for shaving. So like Gillette is definitely a big spender in marketing and sales and etc. But at the end of the day, if somebody is just looking for a job to be done and just sharing, they don't really have much of a thing going on for them. So my point is that while we can discuss the merits of the underlying
yeah,
business, the primary reason why people buy low beta is because they're scared of drawdowns, and they want something that doesn't fluctuate widely. And that I agree, right? So to give you an example, right? So say something you have, say you have an investment of a portfolio that can give you 20% annualized returns, for
yeah,
example. But it gives that with a 10% standard deviation. So what happens is, say till yesterday, you were looking at a 20% gain. All these are hypothetical examples,
yeah,
right? So you're looking at 20% gain. Today, you go and say, okay, I want my money back. Chances, and what if at that point it draws down by 10%?
right,
So your CAGR is now up in smoke, and you get only 10% back. And sure, if you hold it for another 5 years, maybe it'll come back, but it might again give you 20% CAGR. But at the time at which you want to withdraw your cash, you may not realize that 20% because it is so volatile, right?
right. and
So
and and also, if you think about it, right, low volatility, you know uh, the reason why it's low volatile, is because of the drawdowns, it's not like drawdowns don't happen. It's just that they happen very specific to the company.
Right. But the problem is, when you create a portfolio, right? The portfolio dynamics is completely different from picking individual stocks. So while Gillette can have a low volatility, ITC can have low vol, 3M India can have low vol. You put them all, in a portfolio. The problem is if they're all highly correlated, then what will happen is they might all come down and go up at the same time. So the portfolio volatility dynamics might be additive. So and at the same time you're saying that I am not I'm buying this because of low vol, and most of these companies are kind of flatline growth. The problem also comes in from a regulatory slash legal risk as well. So our government, is the aces in changing the rules of the game, midway. So some sort of a dividend tax or caps on royalty
Yeah.
payments, blah blah blah. So any of these can blow up, a portfolio. And if you're concentrated in those kind of stocks, then what will happen is, that risk kind of hits you at the same time, right? The correlation of one. So you're not mentally prepared to handle that. So while a guy who's investing in momentum knows that this thing is a volatile beast, whereas a low vol guy, he does not want that. But that's exactly what he's getting, when things go bad. So my preferred way of, accessing this low vol is actually at the portfolio level. So supposing you have two stocks, and I've put the diagrams up, on the newsletter. So supposing you have two stocks, right? One is volatile at T, uh, and the second stock is volatile only at T plus one, right? So what happens is when you add them together, so they're not volatile at the same time. So when you
Yeah.
add up the walls at the end, at a portfolio level, you end up with a lower volatility portfolio, right? So you can have a lot of volatile stocks as long as they are not correlated to each other. You can end up with a lower volatility portfolio, and this is called optimizing the portfolio, right? So it's like portfolio is optimized for minimum variance and minimum tail risk and so on. So this is my preferred way of doing it. So when you actually open up the portfolio, the stocks themselves may be very volatile, but together, they give a more consistent volatility profile that is lower than the constituents. And I prefer this approach. And if you look at the US experience as well, this sort of optimized portfolios have outperformed a portfolio of low volatility stocks. Um,
Right.
and it's the same dynamic in place. So because there was a time when all your food and beverage stocks, like the so-called what was that consumer um,
Like FMCG.
essentials, right? Yeah, FMCG. They all tanked in the US because this whole DTC thing was going full steam. There were companies hitting $1 billion revenues in like a couple of years after after founding. They all had niche brands. I think we discussed Gillette. So there was this Let's Shave, and there's what is that, Dollar Shave Club.
Yeah.
They all were primed to give a run for their money. So they all tanked at the same time. So whichever portfolio had these stocks, especially these so-called low vol portfolios, took a hit at that point. So it's
So,
always dangerous to hitch your wagon to individual stocks behaving in a low vol fashion. So
so
I
Sham,
prefer this approach.
so Sham, do you know this? I mean, like better than me. So when I mentioned that like specific stocks, right? Like if I have say a portfolio of 20 stocks of like low volatility, I'm betting that yeah, there might be some I mean like idiosyncrasy risk, like for say if like for say some specific company like Gillette or something might have some news, like some specific, like some corporate governance or something like specific to that company, which might send it to stock there. But I have 19 other stocks in my portfolio, and that is not. I'm betting that those stocks are uncorrelated to each other. So I might have 3M India and like MRF, and maybe a couple of more other, like say like Oracle India and stuff, which are which I believe which are not at all related to what Gillette does. And I'm betting that the overall correlation of the portfolio is much lower to the market and to each other's stocks. So I'm hoping that when one stock falls, they will the rest of the stocks may not fall because of that one stock, and when the market falls, these stocks will fall less than the market. Is that true according to you, like from the results that you run?
Not really. So what happens is, first of all, low beta doesn't mean negative beta, right?
Yeah.
So, when the market falls, this also falls. And when you're looking at just the beta, over a cycle, what happens is the betas during market falls can be drastically different from the betas during market rises. So people have tried to differentiate this between as a bull beta and bear beta. So it kind of sounds corny when you say it out loud, but the beta during when the market is rising versus the beta during when the market is falling, and you can't have it both ways, right? You can optimize it saying, okay, I'll buy stocks that don't fall as much as the market falls when it's bad, but at the same time your bull beta can be drastically lower than your actual beta.
So you don't make, so you don't make, so you don't. So when the market recovers, you perhaps recover much less than what
Right.
you.
Right. So, and your rate of recovery could be prolonged, right? So you might see your Nifty go up, whereas your low vol portfolio is struggling to catch up,
Yeah.
right? And that is frustrating as an investor to see that, right? And on top of this, if your returns are not keeping up with, just investing in, in a liquid fund, right? Then you have this double whammy saying, okay, as a low volatility investor, what exactly do I really
I'm
want?
making.
Yeah. Yeah. So if I just want low vol, I can just buy, liquid Bs, or a liquid fund, and keep it and clip, 6 or 7% or whatever.
Yeah.
So why am I investing in stocks? So I want my stock portfolio to go up. But and sure, it didn't draw down as much during the bear phase, but now I'm sitting here and I'm watching Nifty soar, and my portfolio, is still in the drawdown. So it's very difficult from a psychological point of view.
Yeah. Yeah. I think I also think it's like for the type of investor, you know. So I think uh, while I like the idea of low volatility theoretically, I think it's not a portfolio that I might be track every day or stuff. So it's also, so if you're a person who wants to track your portfolio every day and and see what's happening, or like every week, and track performance and stuff of it, then it's not the thing for you. But if you're an investor who's looking probably for 10, if you're looking for 10 years, does low volatility outperform Nifty?
Like I said, my biggest problem with low volatility is cliff risk, and when you're looking at a 10-year period, those cliffs do occur. So
Do
my
they occur? Do they occur at the same time as the market?
No, it's that's the nature of the cliff risk in low vol stocks. So they there's no way to time them. They're mostly accidents, and when those accidents occur, there is there's a rush towards the exits, and that is basically the biggest problem, because these low vol stocks are no way cheap.
Okay.
X P ratio or something. It's some gigantic number
78.
there. So there's a rush towards the exits, and but one area where I've had decent success is actually taking momentum and wrapping it in an optimized portfolio. So what you have
So what do you
is,
mean? So what do you
so
mean?
so it's kind of like financial engineering to some extent. So what you do is, say you have 1,000 stocks, right? You rank them by their momentum scores, right? So my favorite way of ranking this is relative momentum. Then you take the first quintile of these stocks, and then you put them through a portfolio optimizer to reduce their volatility. And one of the constraints you give the optimizer is that I don't want more than 30 stocks. Then I don't want any stock getting a weight of more than 10%. So with these constraints, get me a long only portfolio, right? So it'll try different weights for different stocks, look at the correlation matrix and so on, and spit out a list of
Yes.
stocks with the weights and so on. And you do this regularly on a monthly basis. So what I've seen is this portfolio will outperform a low wall portfolio. Number one, it will outperform your benchmark over a decent horizon, like over a 3 or 5 year horizon. You will beat your benchmark,
Yeah.
right? Because it's mostly momentum stocks. But at the same time, it does not draw down as much as a momentum portfolio, and neither does it soar as high as a momentum portfolio. So
So
you don't
you
get the rush, neither do
yeah,
you get
the benefit of
the
safe haven.
yeah.
Yeah. Yeah.
So it's kind of
And
like an in-between thing, but it sounds very counterintuitive for the average investor. So selling it is a problem, but it works.
so would you have this thing about defenses in the market, right? Like like people, like you always hear this term sector rotation, that people are moving towards defensives, and in India defenses are IT and pharma and these kind of companies, right? Are Is low volatility a defensive place to be if the market falls? No, right?
I don't think so. No.
Yeah.
So historically, when you construct a portfolio, 20, 25 stocks, they all sort of have a beta, right, to the market. So it's not negative correlation. It is not negative beta. It is at the end of the day beta. So just because it's low beta doesn't mean
Yeah.
it's some magic going on over there. So in my experience, right, so having discussed all these factors and everything, I would like to leave one strong message to people looking at this sort of systematic investing. It is not some
Magic.
pixie fairy dust that you sprinkle and boom, you're like Jim.
Yo.
So this is not that. So as a retail guy, you're going to be long only. So when you're long only, the biggest impact that your portfolio is going to have is the beta of the market. So if the market goes up, your portfolio is going to do well. The market falls, your portfolio is going to tank. There is no escaping that.
Yeah.
So if as soon as you internalize this, the better it is for you, right?
Yeah. Yeah.
So pick your markets wisely. So you don't have to be only in India doing this shit, right? You can be in the US markets. You can be you can access Japanese markets through ETFs and so on. So you don't need to be only in India doing this.
Yeah.
So yeah.
Yeah, that is for, I mean, investing in like international market stuff is, I think, a topic for us for like is for like another day. Like we'll have a long discussion, not only once, but I think many times. I mean, over the course of this newsletter, we will talk about like having strategies and stuff, like for international markets.
All right, guys, we've already blown through 30 minutes of your time. So thank you for tuning in to this week's free float. We will catch you again next week. Bye.
Bye bye.